Central banks claim their goal is price stability, but the data tells a different story. Since 2008, central bank balance sheets have expanded from $5 trillion to over $30 trillion according to the BIS. Yet during the same period, real wages have barely moved, and asset prices have surged well beyond what most people earn. The result? Savers face negative real returns, a pattern that echoes what happened after World War II, when financial repression quietly eroded purchasing power for decades. This documentary exposes the uncomfortable truth. Central banks aren't protecting your purchasing power. They're protecting the system itself. Understanding why requires looking at the scale of global debt and the tough choices it forces on policymakers. This is the debt paradox. Public debt in advanced economies now averages near 120% of GDP, according to the IMF. At these levels, the playbook for central banks changes. The focus shifts from managing inflation to managing the risk of default and systemic collapse. Governments face a stark reality. With debt this high, history offers only two real options: default or inflate the debt away. The political costs of outright default are severe, so policymakers often choose the less visible path. Controlled inflation, kept just high enough to erode the real value of debt, becomes the preferred tool. This isn't a new idea. After World War II, the US relied on financial repression, with the Federal Reserve holding interest rates below inflation for years. According to the IMF, this approach helped reduce the US debt-to-GDP ratio by over 50 percentage points, mostly by allowing inflation to outpace returns on government bonds. The scale is different now. Today's debt burden, relative to GDP, far exceeds the post-war era. Central banks in the US, Japan, and Europe all face what economists call fiscal dominance, where the need to finance government deficits shapes monetary policy decisions. The Federal Reserve, for example, kept rates near zero from 2008 to 2015 and launched multiple rounds of quantitative easing, expanding its balance sheet by over $3 trillion between 2008 and 2014. Each crisis brings more intervention, not less. COVID-19 stimulus alone doubled the Fed's balance sheet in just 18 months. The mechanics are straightforward. When inflation runs higher than interest rates, the real value of debt shrinks over time. A 2% inflation target isn't about true price stability. It's the minimum needed to prevent debt from becoming unmanageable. When inflation spiked to 9%, central banks hesitated to raise rates aggressively, revealing the bind they're in. This dynamic creates a system where governments, corporations, and households are encouraged to borrow more, all relying on the expectation that central banks will keep money cheap. Since 2008, debt-to-GDP ratios have climbed past World War II highs in major economies, while central bank balance sheets have ballooned from $5 trillion to $30 trillion globally. Yet inflation-adjusted wages have barely budged. The end result? Central banks maintain policies that quietly favor debtors over savers. The next section will break down how this policy choice shows up in your everyday finances, and why the gap between what you earn on your savings and what inflation takes away is no accident. This is the silent tax at work. It operates quietly, not through direct levies, but by eroding the value of your savings year after year. For example, while your savings account might offer 1% interest, inflation running at 4% means you lose about 3% of your purchasing power annually. According to Investopedia, in some cases, savers have lost 2 to 3% per year as inflation outpaces capped deposit rates. This gap is not accidental. It's a feature of the system. Official inflation statistics often understate the true rise in living costs. They omit or underweight essentials like household appreciation and healthcare. Substitute measures such as the CPIE, which tracks spending patterns for older Americans, show inflation rates 0.5 to 1% higher per year than the headline CPI, according to the Bureau of Labor Statistics. Over time, this difference compounds, eating further into the real value of your money. Negative real estate rates are the system's primary tool for this wealth transfer. When policy rates remain below inflation, debtors pay back loans with cheaper dollars, while savers see their deposits lose value. This dynamic isn't theoretical. Over the past decade, real returns on government bonds in advanced economies have remained persistently below inflation, a pattern noted by the IMF. The European Central Bank maintained negative deposit rates for much of the past decade, a documented form of financial repression. Who benefits? Governments, for one. The U.S. Treasury saves hundreds of billions each year when it can borrow below the rate of inflation. Corporations also gain, borrowing at low rates to fund buybacks or expansion. Mortgage holders and large asset owners refinance and lock in sub-inflation loans. Meanwhile, households leaving money in savings accounts have lost significant purchasing power since 2008. Pension funds relying on bonds face mounting shortfalls. Retirees, dependent on fixed incomes, are forced to either spend down principal or accept a lower standard of living. The scale is significant. Studies from the Bank for International Settlements estimate that negative real rates shift 1 to 2% of GDP annually from creditors to debtors. That's over $1 trillion each year in developed economies. Central banks acknowledge these effects. Their own research papers discuss how financial repression redistributes wealth. This isn't accidental fallout. The system is designed to keep real rates low, encouraging risk-taking and leverage, as noted by the BIS. Central banks use a range of tools: quantitative easing, yield curve control, forward guidance, to maintain this environment. Even small policy announcements, like the Fed's 2020 decision to let inflation run above target, signal an ongoing commitment to eroding debt burdens through higher inflation. This silent tax changes incentives. Holding cash leads to slow but certain losses. Policy steers capital away from safe deposits and toward assets that can better withstand inflation. The outcome isn't just about lost interest. It's about who gains and who falls behind. The next layer of this story reveals how these policies have reshaped wealth distribution on a scale few anticipated. Asset inflation inequality is the direct result of how central banks have managed economic crises since 2008. The expansion of advanced economy central bank balance sheets from $5 trillion to $30 trillion between 2008 and 2023, according to BIS data, was meant to stabilize markets and stimulate growth. But the reality is that most of this liquidity flowed into financial markets, not into the broader economy. A large majority of QE funds entered asset markets, reinforcing the portfolio balance channel and lifting equities and real estate far more than wages or business investment. The mechanism is straightforward. When central banks buy bonds and inject liquidity, financial institutions look for higher yields, driving up the prices of stocks, bonds, and real estate. Studies consistently show QE's impact on asset prices far outweighs its effect on GDP growth. Asset holders, already wealthier on average, benefit disproportionately from these price increases. The result is a widening gap between those who own assets and those who rely primarily on wages. The numbers illustrate the divide. U.S. household net worth roughly doubled between 2008 and 2021, rising from about $50 trillion to $130 trillion, according to Federal Reserve data. Yet this growth was not shared equally. The Fed's survey of consumer finances shows a disproportionate share of asset price gains accrued to the wealthiest households. The top 10% hold the vast majority of equities, and a similar concentration exists in real estate and other appreciating assets. Meanwhile, median real wages rose only in the single digits over the same period. This pattern is not accidental. Central banks use the portfolio balance channel to encourage risk-taking, pushing investors out of safe assets and into riskier ones. Pension funds, facing low yields, shifted into corporate bonds and alternative investments. Private equity firms used cheap debt to buy up housing stock, contributing to rising home prices. Retail investors, in search of returns, piled into index funds and ETFs. All of this activity pushed asset prices higher, while wage growth lagged behind. The effects are visible in everyday life. Home prices in major cities have soared, putting ownership out of reach for many. Investment firms now own large shares of residential housing, while first-time buyers struggle to compete. Stock market gains overwhelmingly benefit those who already have significant portfolios, reinforcing existing wealth gaps. Monetary policy, especially through QE, has become a structural driver of wealth concentration. Central banks acknowledge that their actions have distributional effects, but these effects are rarely emphasized in public statements. The policy framework rewards those who hold assets and leaves wage earners and savers with diminishing purchasing power. Understanding this dynamic is crucial for anyone trying to navigate the modern economy. The rules have shifted. Asset ownership is now a prerequisite for keeping pace with rising costs and maintaining wealth. This environment is not the result of random market forces, but of deliberate policy decisions that prioritize asset price stability and market confidence. But central banks don't just shape outcomes through their actions. They also shape perceptions. The language they use is as carefully crafted as their policies, setting expectations and managing reactions long before any rate change or asset purchase. Central banks use language as a deliberate policy tool, shaping outcomes by influencing expectations. When the Federal Reserve described inflation as transitory in 2021, they weren't simply making a forecast. They were giving themselves cover to delay action. That single word bought time, holding off rate hikes for months while inflation gathered pace. Debtors benefited, locking in low borrowing costs while savers watched their purchasing power shrink. This wasn't a miscalculation. It was intentional messaging. The essence of this strategy is expectation management. Academic studies show that policy statements often move markets as much as actual rate changes. The words chosen in press conferences and official statements are tested, repeated, and refined to generate specific reactions. Phrases like transitory or patient serve as verbal tools. Research finds bond yields react strongly to language shifts, sometimes more than to the policy moves themselves. The European Central Bank and the Bank of England have both acknowledged that communication is now a core instrument of monetary policy, not just an afterthought. Consider the transitory episode. Fed officials repeated the term through mid-2021, even as core inflation measures like the PCE index continued to rise. This narrative delayed the tightening cycle, keeping mortgage rates and other borrowing costs lower for longer. The result was a refinancing boom, asset price surges, and a further squeeze on savers. This wasn't a side effect. It was an engineered outcome, using language to steer market behavior without immediate policy changes. Central banks refer to this as open-mouth operations. The practice dates back to the 1990s, when forward guidance became a way to manage volatility and smooth transitions. According to BIS research, well-telegraphed policy changes reduce market volatility by about 30%, compared to surprise announcements. The message is clear. Language is often as powerful as the tools on the balance sheet. This approach is systematic. Transcripts show that central banks debate not just what actions to take, but how to frame them. When debt levels are high, officials lean on conditional language, words like may, could, or some, to avoid spooking markets or raising borrowing costs. Analysts and investors now study every phrase, parsing for hidden signals about future moves. The code is well known. Subdued inflation pressures signals no hikes. Broad-based price increases means action is coming. The impact is direct. When central banks soften their language, credit markets respond instantly. Lenders adjust mortgage rates, corporations time their bond sales, and pension funds recalibrate their return assumptions, all based on the tone and wording of policy statements. The public narrative can mask underlying policy shifts, buying time or easing transitions without dramatic moves. This creates a paradox. Increased transparency in communication often coincides with greater opacity about true intentions. Central banks publish lengthy reports and offer frequent updates, but the most important signals are embedded in carefully chosen words and what remains unsaid. The silence, the qualifiers, and the subtle shifts all carry weight. As language becomes a primary instrument of policy, it sets the stage for a deeper transformation. The next turning point comes when central banks move beyond words and begin to blur the very boundaries between monetary policy and government finance. This shift is called the quasi-fiscal turn. After 2008, central banks ran out of room to cut interest rates and started using their balance sheets as shock absorbers for the entire financial system. The Federal Reserve's assets expanded tenfold, from about $900 billion in 2007 to nearly $9 trillion by 2023, according to Fed data. The European Central Bank's bond holdings now represent a large tranche of euro area government debt, far above post-crisis norms. These aren't emergency measures anymore. They've become structural features of how economies are managed. Yield curve control makes this clear. When the Bank of Japan capped 10-year bond yields at 0.25% starting in 2016, it effectively became the largest buyer, owning over half of Japanese government bonds by 2023. In the US, the Fed's pandemic-era bond buying peaked at $120 billion per month, covering a majority of new government borrowing at the time. The ECB's Pandemic Emergency Purchase Program backstopped entire national budgets, with Italian 10-year yields dropping even as debt soared. The Bank of England's COVID response saw it purchase enough gilts to finance all new government borrowing for several months. These interventions go beyond stabilizing markets. They directly finance government deficits. The consequences are now visible on central bank balance sheets. The Fed's unrealized losses on its bond portfolio reached $1.3 trillion in 2022. The Bank of England required a £65 billion recapitalization when gilt prices fell sharply. The ECB faces potential negative equity that could require tens of billions in recapitalization if losses are realized. These losses don't vanish. They eventually move onto public balance sheets, connecting monetary intervention directly to fiscal outcomes. The Bank of Japan earns minimal or negative returns on many of its government bond holdings, a byproduct of persistent low-rate policy. Regulation and policy reinforce this structure. Italy, for example, requires its banks to hold government bonds equal to 10% of deposits, well above the EU average. Japanese banks and insurers hold vast sums of government debt, often because regulations and prudential standards push them to do so. This captive demand keeps borrowing costs low, but distorts credit markets and crowds out private investment. Retail investors are drawn in as well. Japan's NISA program channels household savings into government bonds through tax incentives. The UK's National Savings and Investments bonds offer below-inflation yields to help fund public borrowing. These aren't just savings products. They're tools for financing government deficits by tapping household wealth. The result is a system where monetary and fiscal policy are deeply intertwined. Central banks act as key funders for government spending, and their decisions now shape fiscal sustainability as much as inflation or employment. When policymakers hesitate to tighten or unwind these programs, it's not only because of economic growth or inflation targets. They're also watching the impact on government debt service and financial stability. This evolution sets the stage for the next phase of financial control. As the architecture of monetary policy adapts, new tools emerge that promise even more direct influence over money, savings, and spending. Central bank digital currencies, or CBDCs, mark a turning point in monetary policy. According to the BIS, over 100 central banks are exploring CBDCs, with about 20 pilots underway. This is not just about updating payment systems. CBDCs represent the first time central banks could exercise direct, programmable control over individual money balances. The technical capabilities set CBDCs apart from any previous form of currency. With digital infrastructure, central banks can monitor transactions in real time, restrict spending by category, and adjust interest rates on deposits instantly. Chinese pilots include limited-time vouchers, hinting at programmable features that could make money expire if not spent. The European Central Bank's discussions include managing CBDC interest through tiered balances to prevent large-scale bank withdrawals. These are not conveniences for consumers. They're levers of control that can be pulled in response to policy needs. The global push for CBDCs is not happening in a vacuum. It comes as governments face historic debt levels and search for new ways to manage liabilities. When cash alternatives disappear, negative interest rates and targeted stimulus become easier to impose. Programmable money can enforce spending deadlines, apply taxes at the point of transaction, or restrict transfers above certain thresholds. In Jamaica, CBDC infrastructure already enables direct stimulus payments with expiration dates. Nigeria's Inera limits large cash withdrawals to nudge adoption. Each feature shifts more power toward the state and away from the individual. Privacy and autonomy become negotiable. CBDC wallets can be designed to verify identities for even small transactions, as seen in EU proposals. Every payment, transfer, and balance could be visible to authorities. The IRS is already developing AI systems to analyze digital transaction data. In China, digital yuan wallets are linked to social credit profiles. These developments show how programmable rules can become financial constraints, not just technical upgrades. Official reports suggest CBDCs could preserve the role of central bank money and enable direct policy impacts on wallet balances. This means monetary policy could be applied at the level of the individual. Negative rates deducted automatically, stimulus delivered with expiration dates, and savings penalized through real-time adjustments. The technical infrastructure is being built while debate lags behind. For individuals, the implications are clear. A fully digital, programmable currency system gives central banks the ability to enforce policy directly on every unit of money. When cash disappears, options for privacy and autonomy shrink. The environment for savers and asset holders changes fundamentally. This is not a distant scenario. The groundwork is being laid now. Recognizing this shift is essential for understanding the system's priorities. The next step is to see how these policies fit into the broader framework of debt management and financial stability, and what that means for your own financial strategy. This is not a system malfunction, it's a deliberate design. Central banks focus on debt sustainability and financial stability, even if that means savers lose ground to inflation. The result: stocks and real assets have vastly outperformed cash and bonds, while savers' purchasing power has eroded. Policy choices continue to favor asset owners and debtors over those who hold cash. In this environment, consider minimizing allocations to low-yield instruments that have consistently lagged inflation. Focus on assets with built-in inflation hedges or real yield, like dividend-paying equities or real assets. The key is to align your financial strategy with how the system actually operates, not how it's supposed to work.